Hello, welcome back to another video. In today's video, I'll be covering a $650,000 portfolio that a viewer actually submitted. If you guys are interested in getting yours reviewed as well, please send it to the email in the description box below. So for reference, this is my portfolio, but of course, I won't be covering much about my portfolio today. So in today's video, I'll be zooming in on this portfolio, and the portfolio is here. So he has around 78% of his portfolio in US-based companies. He has 14% in Asia-based companies and around 7.5% of his entire portfolio in Bitcoin. So he bought into Bitcoin relatively early. I mean, he's sitting on massive gains right now. He sees it as a bet, a small hedge against the US dollar, and it has paid off massively. So congrats on that one. But let's talk about his US equities first. So these are his US stocks. He currently has around 6 positions in his entire portfolio, extremely concentrated. So he has Amazon, he has Google, he has Microsoft, Tesla, SoFi, as well as ASML. So out of these positions here, I view 4 of them as extremely high quality. Of course, you have ASML, Amazon, Google, as well as Microsoft. I don't really agree with the Tesla one, and SoFi is more of a speculative play that has paid off massively for him as well. So let's talk about Tesla first. So Tesla is a stock that I view as fundamentally detached from reality. I mean, the stock is purely trading off of sentiments, and there's extremely high key man risk for this stock. So the only reason people buy into Tesla is simply because of Elon Musk. I mean, Monish Prabhai has previously also said as well, he doesn't believe in the product, he believes in this man called Elon Musk, which I completely understand, but for me, it's a bit different. This viewer here is sitting on massive gains right now. I think he bought Tesla at a relatively low price, so his small bet on this Tesla stock has paid off massively. As for his second largest holding, he has Google. So Google is around 21% of his entire US portfolio. So Google is currently up around 5% year to date, currently trading at a 21 times of earnings. So Google for me, it's a high quality business. I have the largest position in Google as well. It's currently around 11 to 12% of my entire portfolio. For Google, I think it is a company that is fundamentally detached from its stock price. I mean, the stock price is going down while the fundamentals are going up. It is completely opposite to Tesla. So for this investment, I completely agree with it. But of course, if you're a Google investor today, you should be taking note of the DOJ settlement, which could come out in the next 2 weeks or so. So they previously said that this DOJ lawsuit thing will come out in around August. So you can expect a piece of news coming out over the next 1 or 2 weeks, which could hurt the stock price. But for Google, long-term wise, I view this as a high-quality business that I'll continue to hold. Of course, there are risks attached to it, so I might trim my position. But other than that, I view this as a high-quality business, one of the best quality ones in your S&P 500. The next portion that I'll be covering is his China portfolio. So in his China portfolio, he has only 3 stocks. He has Alibaba, he has Meituan, as well as JD. So he has the 3 big guns here, the 3 retail guns. So he bought heavily into all these Chinese companies because he was betting on a China recovery. I mean, the Chinese stock market has been experiencing sort of like a bear market in 2023 as well as in 2024. So the stock market was down around 60% at one point. And he bought heavily into all these different companies during that time. The only company that he's slightly down in the water on is Meituan, where he just added a small position to it. For me, I think all the China companies, the China retail ones, are extremely competitive. I've been researching a company called Chagi as well, and in the space, it is incredibly competitive. I don't think anyone will end up having a dominant share in the retail space. And for these 3 companies here in the retail segment, as well as another company which is Pinduoduo, it is incredibly hard to find a clear winner, which is why you buy all of them. But of course, there's a counter argument to this as well, which is that the operating margins for all these companies could come down if they start to lower costs to gain more market share, which is what we've seen from some of these firms here. So I'll be zooming in on Alibaba. Alibaba is a stock that is up nearly 40% year to date. It is currently trading at a 15 times earnings, and on an adjusted basis, it is currently trading at around a 17 to 18 times of earnings. So for Alibaba, a competitor, which is Baidu, Baidu has their own cloud as well, and Baidu recently reported their earnings. So they saw a cloud re-acceleration in that portion. The cloud business grew by around 27%, and for Alibaba, it is the largest cloud player in China, so we could expect a re-acceleration in terms of growth in that portion as well. For Alibaba, if I'm buying into the stock, if I'm interested in the stock, the majority of my investment theses will be surrounding Alibaba's ability to grow in the AI portion, in their AI cloud portion. But of course, there are risks to that as well, which is why I'm holding back on this investment. I think the retail portion is a weak portion that Alibaba has, although it is the most dominant player in the space. And besides that, they're spending billions of dollars in capex, and they've historically not been able to deploy this cash at high rates of return. So those 2 reasons are why I haven't bought into Alibaba yet. It is a decent quality business. I've looked it up. But of course, there are risks to all these different portions of their business. So this is his full portfolio. It's around $650,000. It's sitting on around $270,000 worth of gains. So as you can see, he has Google here around 11% of his entire portfolio. He has Alibaba, which is at around 5%, sitting on around $9,000 of gains. He has Meituan, around 2%. He just added into this stock. This stock is a food delivery company in China. It is similar to DoorDash in the US, just that it is in China. So in China, you have a lot of different food delivery apps, which is why the stock has been down massively over the past 2 months, 3 months or so, because of the high competition. And besides that, he has the CFA REIT ETF as well. I mean, REITs are just stable growing dividend giving companies. And I own quite a fair bit of REITs in Singapore as well. And besides that, he has ASML around 3.5% of his portfolio, Microsoft at around 7%, Bitcoin at around 7%. He's sitting on $37,000 worth of gains. He bought it in at $10,000, so he has 10x his position. He has Tesla at around 15.9% of his entire portfolio. So his cost basis is around $55,000, so he bought it in at an average price of around $160, and currently it's around $100,000. He has JD, which is $15,000 of cost basis at $18,000 market value right now. For JD, I think it's a company that is decent quality in China. It's cheap. For JD, I view it as a company that is highly competitive in your retail segment, but of course the retail landscape is one that is extremely competitive. So that's why despite the valuation being very cheap, I don't think I'll be investing into this one. As for his other plays, he has SoFi as well. So SoFi is sitting on massive gains this year. He has CSPX, which is the S&P 500. He initially bought into CSPX. He has Amazon, as well as the Vanguard All World ETF. As for his total net worth, this is his entire net worth. He has around $800,000 in a house. He paid off the house completely already. He has $650,000 in stocks as well as Bitcoin. And he has around $140,000 in cash. So his current cash position is around 9 to 10%. So if we see a significant market drawdown, then this cash position could be one that is quite useful. As for his house in Singapore, for Singapore, your normal housing prices go up by around 3 to 4% every single year. That's what the real estate agents will say. So in Singapore, ever since 2018 or so, the housing market has just been going up almost every single year. It's a steady uptrend. And the only reason why it dropped over here was because of ABSD. So additional buyer stamp duty increased the supply and reduced the demand. So that's why your housing prices actually dropped by quite a fair bit. But I view Singapore property as a decent investment if you're looking into getting one. It's stable, and of course, if you're applying leverage, then the returns could be a lot more. I calculated and you can get around a 12.5% returns on a $1 million flat in Singapore with a total down payment of around $270,000. So that's a 12.5% on leverage, of course. It is probably more steady than stocks, but of course you won't have cash flow coming in because the entire rent that you get from the house will be taken away, will be accounted for by the mortgage that you have to pay, as well as all the maintenance fees. So I'm guessing his age is around 35 or 40 this year. I'm not too sure what his age is, but if let's say he retires at 55 years old, his $650,000 this year will get him around $4.3 million in 20 years time if let's say he retires at 55 years old. As for his other segment, his housing portion, his house will probably appreciate to around $1.7 million in Singapore in 20 years time. So a total of $6 million if you put it into a dividend investment in Singapore like DBS, OCBC or so on at around 5% return. That is a decently saved $300,000 in dividend income every single year from this $6 million. So congrats to this guy. He's in a situation that is extremely good. He's set for retirement in the future. And this is what most of us want to get to, of course. Next portion, I'll be covering some questions left in the comments. So the first one is, says, Guan, what do you think about Novo Nordisk or Eli Lilly? So for Novo Nordisk as well as Eli Lilly, they operate in your pharmaceutical sector. So Novo Nordisk as well as Eli Lilly, they predominantly sell your weight loss drugs. But of course, the risk with Novo Nordisk is that the entire company's pipeline is concentrated in your weight loss drug portion, and it's been impossible for them, or at least it's been hard for them, to pivot away from this weight loss drug portion. Whereas for Eli Lilly, they have a larger range in terms of their pipeline. So Eli Lilly is probably the company that will do a lot better in the future in terms of the earnings. But of course, valuation comes into play as well. Novo Nordisk is trading at a 13 times earnings. Eli Lilly is trading at a 30 times forward earnings. So that's around a 2 to 3x in terms of valuation. I think at today's price, Novo Nordisk is providing the better opportunity. But of course, the pharmaceutical companies comes with risk. I mean, you saw the other company, which is Vertex. Vertex was down around 42% in one single day. after they had some trial results. So if you're unfamiliar with this space, I would entirely avoid it. The next comment it says, MasterCard is outperforming Visa this year. Any thoughts about that? So for MasterCard as well as Visa, I view their companies as well as their business models as completely similar. So I would view them as a single stock position. I don't think there should be anything to worry about in terms of MasterCard and Visa. I think Visa is the better value buy right now, which is what you saw with some of the 13Fs as well. So Chris Horn added into Visa. He probably thinks that Visa is the better value buy today. I agree with him. I think Visa and MasterCard, they are almost 100% similar. So you can just buy both and equally split the position depending on valuation. I hope you guys have found this one useful and invest